October 19th, 1987. A Monday that began like any other and ended as one of the most violent days in financial history. By the time the closing bell rang on Wall Street, the Dow Jones Industrial Average had fallen 22.6% in a single session. Not over a quarter, not across a long, brutal bear market, but between opening and close on one ordinary trading day. Entire fortunes that had taken a lifetime to build were erased in a few hours. On the floor of the New York Stock Exchange, veteran traders who thought they had seen everything stood staring at the screens in disbelief while prices collapsed faster than they could even shout the quotes. If you're interested in personal finance, hit subscribe and give this video a like right now. And now, let's move on. What made Black Monday so disturbing was not just the size of the crash, but the absence of a clear reason. There was no terrorist attack, no sudden outbreak of war, no major bank failure, no single piece of news that could justify such an extreme move. When the dust settled and analysts went looking for a culprit, they discovered something uncomfortable. The market had not been crushed by an external shock. It had been wrecked from the inside by a mechanism that was supposed to make it safer. A neat piece of financial engineering that had been marketed as insurance had instead created a kind of financial death spiral. A self-reinforcing loop where forced selling triggered more forced selling until there were almost no buyers left. That mechanism was portfolio insurance. And if you are watching this in 2025 and own stocks, index funds, ETFs, or even just have retirement savings linked to the market, you need to pay attention. Because the logic behind portfolio insurance did not die in 1987. It evolved, multiplied, and spread. The labels changed, the technology improved, the strategies moved into new wrappers, but the core structure that nearly took down the market 4 decades ago is still here. Only now it controls far more money, operates at much higher speed, and is woven into products that everyday investors are told are the safest way to grow their wealth. Most of the financial industry will not tell you this. Brokers, fund companies, and commentators on television have a strong incentive to reassure you that everything is under control. They like to talk about diversification, time in the market, and the wisdom of staying invested. Meanwhile, people who spend their time studying the plumbing underneath the market's glossy surface see something very different. They see a structure that has become more fragile, not less. They see flows that are highly synchronized, strategies that all depend on being able to sell into the same pool of liquidity, and a set of rules that ensure that once selling starts, the system will push it further. Before we break this down in detail, I want you to pause and take stock of your own situation. Do you have money in the market through a 401k, an IRA, a brokerage account, or a pension? Do you understand what happens to your ETFs, your index funds, and your options positions when the market falls sharply in a single day? Do you realize how much of your passive investing is tied to automatic rules that will react without asking your permission? Tell me in the comments how exposed you think you are. And if you want to keep learning about the risks, almost nobody explains this clearly, make sure you subscribe, because what you are about to hear is the blueprint for how the next crash will unfold. To understand the present, we have to go back to the mid-1980s. The American stock market had been climbing for years. After a brutal bear market and a long fight against inflation in the 1970s, the early 1980s ushered in a powerful bull run. Interest rates were falling, corporate profits were recovering, and investors were enthusiastic about new technologies such as personal computers and telecommunications. From 1982 to 1987, the Dow more than tripled. The mood was optimistic, and there was a lot of talk about a new era of stable growth and permanently rising markets. Investors who had missed the rally felt pressure to jump in before it was too late. In this environment, a new quantitative strategy began to gain popularity among large institutions. It was called portfolio insurance. The idea came from academic finance and was implemented using computers, which at the time were just beginning to be used widely in trading. The premise seemed elegant. Instead of buying actual put options to protect a stock portfolio, which could be expensive, managers could use dynamic trading rules to mimic the effect of an option. A computer would monitor the market and automatically sell stock index futures or stocks themselves when prices started to fall, then buy them back later when conditions improved. Think of a pension fund with a stock portfolio worth $100 million. The managers want to avoid catastrophic losses, so they hire a firm offering portfolio insurance. That firm runs a program which says, for example, that if the market drops 3%, the fund should sell a certain amount of futures contracts or liquidate a slice of its stock holdings. If the market falls another 3%, the program instructs the fund to sell more. Each step down in prices triggers a step up in selling. In theory, this reduces risk because if the decline continues, the fund ends up holding less and less stock, so its losses are limited. In isolation, for a single investor, that may sound reasonable. The problem is that by 1987, hundreds of large institutions were using similar portfolio insurance schemes, all built around the same core idea. They would all sell when prices fell. They would all sell more as prices fell further. And they all relied on the assumption that when they needed to sell, there would be enough buyers on the other side of the trade. Now imagine how this plays out in real time. The market has been strong, but then sentiment wobbles. Concerns about interest rates, trade imbalances, or valuation cause stocks to slip over several days. The decline is uncomfortable, but not yet dramatic. Prices fall a few percent. That small move, however, is enough to trigger the first layer of portfolio insurance selling. Several funds' computer models reach their thresholds and start dumping stock index futures. Selling pressure increases, which pushes prices down further. As prices fall through the next set of levels, more programs activate. They add their selling to the market, pushing prices down even faster. Each drop in price is not just a reflection of changing expectations about the economy. It is also the direct result of these rules-based strategies trying to protect themselves by selling into a falling market. On October 19, 1987, this feedback loop went out of control. The previous week had already been negative, and the mood was fragile. When trading opened on Monday, selling pressure intensified. As the indices declined, portfolio insurance programs began to execute in earnest. Many of them sold stock index futures, expecting to hedge their underlying portfolios. The futures market sagged. Arbitrage traders who tried to keep futures and cash prices aligned began selling stocks to match, and the decline accelerated. Those falling prices triggered more protective selling from other portfolios, which had their own thresholds. The cycle repeated itself over and over. Decline, trigger, sell, further decline, new triggers, more selling. Meanwhile, human market makers, the firms and individuals responsible for providing bids and offers on the exchange, found themselves overwhelmed. When you are a market maker, you are supposed to step in and buy when there are too many sellers, but you have limits. As the selling became relentless, many market makers widened their spreads or pulled their quotes entirely because they feared being run over by an avalanche of orders they could not offset. Liquidity, the invisible cushion that normally absorbs buying and selling, disappeared. Prices gapped lower as sellers hit the few remaining bids, and in some cases, there were literally no trades because no one was willing to bid at all. By the end of the day, the Dow had lost more than a fifth of its value. The S&P 500 showed similar damage. The numbers were staggering, but beyond the statistics was a deeper truth. The crash had not been caused by a sudden collapse in corporate profits or a change in the productive capacity of the economy. It was the result of a structure that linked price declines directly to forced selling. The machine that was supposed to protect portfolios had become an accelerant, turning a normal correction into a historic crash. In the months that followed, regulators and academics tried to understand what had happened and how to prevent a repeat. They implemented circuit breakers that would halt trading if indices fell by a certain percentage in a given period, hoping that pauses would give participants time to catch their breath and restore order. They reviewed the use of portfolio insurance and criticized its role in the meltdown. But while the specific marketing label, portfolio insurance, faded away, the general principle behind it, mechanical trading, in response to price moves, did not disappear. It moved into new forms and spread across the entire market. Jump to 2025, and the marketplace looks very different on the surface. The trading pits are mostly gone, replaced by electronic exchanges where orders from around the world race through fiber optic cables and microwave towers. Instead of a small number of portfolio insurance programs running on clunky 1980s hardware, we now have an ecosystem of algorithmic trading and high-frequency strategies that account for most of the daily volume. These algorithms range from market-making bots that constantly quote prices to momentum strategies that buy what is going up and sell what is going down, to arbitrage systems that try to exploit tiny discrepancies across markets. They operate in microseconds, reacting to each tick in price faster than any human being can even see the change. At first, this might sound like a completely different world, but structurally, the similarity to 1987 is striking. We still have large pools of capital controlled by rules that link price movements to automatic trading behavior. When certain conditions are met, prices falling through particular levels, volatility jumping, correlations changing, the algorithms respond mechanically. Some cancel their buy orders and back away from the market, reducing liquidity. Others begin to sell in order to cut risk or follow momentum. Under calm conditions, their activity can make markets appear very efficient and liquid. Under stress, they can all move in the same direction at once. We got a taste of this in the flash crash of May 6, 2010, when the Dow plunged almost 1,000 points within minutes before rebounding. Investigations later showed that a combination of a large sell order, high-frequency strategies reacting to that order, and the sudden withdrawal of many liquidity providers created a vacuum where prices simply dropped through levels where normally there would have been buyers. It was a miniature accelerated version of what happened in 1987, compressed into a fraction of the time. But algorithmic trading is only part of the story. The most important modern incarnation of the portfolio insurance problem lies in the massive growth of passive investing through index funds and exchange-traded funds. Over the past 20 years, investors have moved trillions of dollars from active managers into products that aim to replicate broad indices like the S&P 500 at very low cost. These funds are marketed as safe, diversified, and almost boring. For many savers, the idea of buying a low-cost index fund and holding it for decades has become the default strategy. To see how the danger creeps in, you have to understand the mechanics. When you buy shares of an ETF that tracks an index, you are not individually buying tiny pieces of 500 different companies. Instead, you are purchasing shares in a fund that itself holds or replicates that basket. The link between ETF shares and the underlying stocks is maintained by a process called creation and redemption. Large institutions known as authorized participants can exchange baskets of the underlying securities for ETF shares, and vice versa. When lots of investors want to buy the ETF, authorized participants create new shares by delivering the underlying stocks to the issuer. When investors want to sell, the reverse happens. ETF shares are returned and the underlying securities are sold into the market. As long as flows are balanced and calm, this machinery works smoothly. The ETF appears liquid and investors can buy and sell shares throughout the day. The illusion is that the ETF itself is a separate pool of liquidity. In reality, it is a pass-through. When you and millions of other investors decide to sell your ETF holdings in a panic, that selling pressure must ultimately be transmitted to the underlying stocks. If redemptions hit a certain level, authorized participants will either sell the stocks directly or take delivery of large stock baskets that they then have to unload. Either way, there is forced selling of the actual companies in the index. Now, combine this with the psychology of a downturn. Suppose the market begins to slide because of a geopolitical shock, an interest rate surprise, or a series of disappointing earnings. Prices fall 10% over a few sessions. Investors who have been told for years that stocks always go up in the long term suddenly see their account balances down by double digits. Many will hold, but a significant minority will decide that they have had enough and hit the sell button on their ETFs. That wave of selling feeds into the ETF redemption mechanism, which in turn pushes selling into the underlying stocks. As those stock prices fall further, more investors become nervous, see more red ink in their statements, and sell more ETF shares. The process reinforces itself. This dynamic is not just a theory. During the COVID-induced panic of March 2020, bond ETFs, especially those holding corporate and high-yield bonds, traded at substantial discounts to the net asset value of their holdings. In other words, ETF investors trying to exit had to accept prices that implied the underlying bonds were worth far less than their last quoted levels. The underlying bond market was illiquid, Dealers did not want to hold large positions just as credit stress was rising. The structure crackled under pressure until central banks stepped in with massive programs to buy bonds and calm the market. That rescue prevented a deeper meltdown, but it did not change the underlying fact that ETF liquidity is highly dependent on the willingness of a relatively small set of institutions to keep making markets. The scale of passive investing is what makes this so dangerous. In 1987, portfolio insurance controlled on the order of $100 billion, which was significant at the time, but small compared to total global equity value. Today, index funds and ETFs control well into the tens of trillions of dollars. They own huge fractions of major indices, and their flows often dominate daily trading. Furthermore, many investors outside of explicit passive funds behave in quasi-passive ways, hugging benchmarks and adjusting their weights mechanically. When money moves in or out of the market, it tends to push on the same names in the same directions. On top of this, consider the role of leveraged and inverse ETFs, which promise to deliver multiples of an index's daily move, or the opposite of that move, by using derivatives. These products must rebalance their exposures every day, which often means buying when the market is up and selling when it is down, reinforcing trends. Add in volatility targeting funds that reduce exposure when volatility rises, and risk parity strategies that adjust allocations between stocks and bonds based on measured risk. Many of these approaches, though they differ in design, share a crucial feature with portfolio insurance. When price declines and volatility increase, they respond by selling. Another crucial layer is the options market. Options dealers who sell put options to investors must hedge their exposure to avoid catastrophic losses. When the market falls toward or through the strike prices of those options, hedging models often require the dealers to sell stocks or stock index futures to stay balanced. That selling can be large and automatic, especially when there is heavy speculative activity in options. Once again, you have a rule-based system that ties price declines to additional selling pressure. Put all of this together, and you can see the modern version of the 1987 structure. Instead of a few portfolio insurance programs sharing a similar model, we now have an entire ecosystem built around mechanical responses to price movements and volatility. Algorithmic traders pull liquidity when volatility spikes. Passive funds and ETFs sell underlying stocks when investors redeem shares. Leveraged and inverse ETFs rebalance in ways that reinforce the prevailing move. Volatility targeting and risk parity strategies cut risk by selling into weakness. Options hedging requires more selling as prices fall. Each component may seem individually justified, but collectively they create conditions where a moderate decline can morph into something far more violent. When you compare 1987 and 2025, the parallels are hard to ignore. In both periods, large pools of capital are governed by automatic rules rather than slow, deliberate human judgment. In both, significant amounts of money are committed to strategies that sell when prices fall, turning the market's own movements into triggers for further stress. In both, liquidity looks deep until everyone tries to use it at once, at which point it vanishes. The main differences today are scale and speed. The sums involved are orders of magnitude larger, and the speed at which orders are executed is incomparably higher. That is why the next crash is unlikely to be a slow, grinding decline. It is much more likely to look like 1987, or the flash crash only bigger. A drop of 20 or 30% in a very short period is not some science fiction scenario. It is a logical outcome of the structure we have built. The catalyst could be almost anything: a geopolitical shock, a surprise central bank decision, a large corporate default, a cyber attack that disrupts trading for a few minutes, or even a simple imbalance in supply and demand on a quiet day that happens to trip the wrong set of algorithms. The specifics matter less than the fact that once a certain threshold is crossed, the rules embedded in the system take over. When that happens, the language you hear on television will be all about panic, fear, and irrational investors. Commentators will talk about confidence evaporating and emotions taking over. There will be some truth in that, especially for individuals watching their savings plunge. Yet behind the emotion will be cold logic, written into code, executing without hesitation. ETFs will follow their redemption rules. Algorithms will follow their trading rules. Risk models will insist on cutting exposure. None of them will care that they are all doing it at the same time. None of them will care that in aggregate they are destroying the very stability they were designed to protect. Afterward, there will be hearings, reports, and proposals for reform. People will talk about unexpected events and perfect storms. Some will blame high-frequency traders. Others will blame ETFs. Some will blame regulators for not seeing it coming, while regulators insist that the shock was unprecedented. But anyone who has studied Black Monday and paid attention to how modern markets are structured will not be surprised. The mechanism is not a secret. It is simply uncomfortable to acknowledge, because acknowledging it means admitting that a huge share of the financial system, including the retirement savings of millions, is sitting inside a machine that can panic all at once. So, where does that leave you as an individual investor or saver? The point is not that you should flee the markets entirely or bury cash in the backyard. The point is that you should not mistake mechanical, index-based investing for immunity from risk. Passive does not mean harmless. It does not mean your money will glide smoothly through every crisis untouched. It means that your assets are being managed according to rules that are simple, inflexible, and indifferent to your personal situation. Understanding that reality gives you an edge that most people do not have. You can think deliberately about how much exposure you want to concentrated indices. You can consider whether to complement passive holdings with assets that are less tied to forced selling dynamics, such as certain types of real estate, private businesses, or cash reserves that give you the option to buy when others are forced to sell. You can educate yourself about the basic mechanics of ETFs, options, and volatility so that when a sudden crash hits, you recognize the pattern instead of being paralyzed by confusion. If this changed the way you look at the market, then do not just click away and forget it. Subscribe, stay tuned, and keep learning how the structure behind the charts really works. Because the next Black Monday will not announce itself in advance. It will arrive through the same kind of feedback loops that have already appeared in smaller form. The question is not whether the machine can break. The question is whether you will understand what is happening when it does.